All right. All right. Welcome everyone to the weekly Camera Plan webinar. It's just now noon, so grab your coffee or lunch, get settled. We have an interesting presentation today, one that one that you'll enjoy. First, some housekeeping. I don't have my standard slide up with regard to our disclosures and whatnot, but we are custodians, Camera Plan. We do not promote, endorse, or recommend any investment products. What you hear today will be strictly educational on the part of our guest and myself. And as with all things investing, we advise you to consult with your CPA, your tax prep specialist, your lawyer, um, whoever is in your team of advisors before you do anything in self-directed investing or investing in general. So today we're going to talk about precious metals. We've invited Brandon Green to come in from Neptune Global. They are the sole source for the precious metals composite ounce, allows you to trade in the primary metals. And they are also a major broker. Brandon, despite his youthful appearance, has spent decades in financial services and in investing, including a stint with Sprott, the precious metals giant. And so we're very happy to have him here today. And he's going to kind of peel back the curtain and show us what goes on in the metals markets and some of the things that drive what you see. It's more than just the price of gold on any given day or silver on any given day. And he will draw a very interesting picture for us on how the markets interact with one another. Brandon, take it away.
Thanks, Joe. Appreciate it. Yeah, welcome everybody. I'm super happy to be presenting here to the audience of Camera Plan. This is we do this about once a quarter, maybe a little bit less, and I'm happy to give you an overview of what's happened in 2025 and beyond through 2026. So today, like I said, we're going to have a little bit of a 2025 review. Going to go over a little bit of what's been happening in the private credit, private equity markets. It's been some big headlines lately. Some stuff that's happened in 2026, some of the predictions. Going to take you into how the physical market actually works, where it goes from mining and the trading and the premiums and just a little bit of the guts in the background that kind of help you understand why the metals are priced the way they are and based on spots and futures and all that other jazz. Going to give you a little bit of a comparison to the ETFs. The ETFs do have their place for certain types of investors or traders, and a little bit about us at the end. You're not going to take too much of your time. I'm hoping to get this done within 20 minutes or so. Okay. Probably won't be that. Always say that. It always goes longer, but oh well. So, um, before we get into 2025, I just got a couple items I want to just throw out there because I think they're very important, just so we can set the stage so you can know that we often, especially the major channels, news channels, websites, whatever they want to be, they always talk about everything else, corporate bonds, S&P 500, euro, yen, whatever it might be. But meanwhile, gold is trading more than most of these. It's a huge market. You know, with the futures, the ETFs, all the jewelry, and everything down the chain, it is a very big market, you know, trading almost 160 billion a day. I think this is a little bit out of date now, but I think it's higher now. So just to put in perspective, this is it's not a small market. It's not something new. I mean, it's older than everything else you see here. I just want to make sure that's understood. I think it's an important fact to put out there. So 2025 metals market review. Let's just see how gold, silver, S&P Dow did end of year last year, so December 31st, and then 1, 10, and 25 years back. Gold outperformed everything. Silver, in the 25 year, it has been a solid performer, outperforming the S&P, outperforming the Dow, and this is total returns. Okay, this is with dividends reinvested, total returns of all of these. So it has been a monster, and it has definitely been the better portfolio performer, despite what some people may say out there, whether they're a portfolio manager, a hedge fund, or a trader, or an RIA, or whatever they might be. Everybody's got different opinions, but the proof is the numbers are there. The numbers are there, and this still holds true to today. But it's easy to do these past returns to the end of years, right? So we kind of get a good context of what's been happening. One very important fact I really like to put out there is that if you are considering investing in precious metals, you have essentially two options, right? You can invest in the physical in some sort of way. Maybe you might do an ETF where it tracks, or it may have the physical backing, or you can go into the miners, right? You can go into the companies that produce the product, right? Well, which is a better play? Which is the one has the better historical outcome? Well, the GDX is an ETF on the market. It has about 50 of the major miners at any time. It does move around based off of these miners get they get bought out, or they go too small to be in the index. Either way, this is 19 years since its inception. The difference between the actual gold price and the return of the miners. Okay, total return. So all dividends. There's this is 4 times, right? Maybe three and a bit times return. Just being in the actual metal itself, the real thing, easy, physical, see it, buy it, done. You don't have to worry about CEOs taking the company down, labor disruptions. Yes, some of these mining companies inside of this firm, if you were really good and you knew what to pick, and you would have done better than gold, but not me, and probably not anybody on this presentation could really figure out which one's going to do best. So I think that's something that's very, very important to understand, right? So why go with all that risk when you can just buy what they produce, right? That's it. If you can buy what they produce, why go without that risk? This is a chart of the foreign central bank holdings from the past 55 years. If you can look down at the 2025 line, you can see it's the first time since 1996 that they are now holding more gold as foreign reserves than treasuries. Okay, so this is something where we really got to take a look at that. Like, the central banks see this as the asset and not treasuries, US treasuries for that matter. They are seeing this, all foreign central banks. They know what they're doing. So this is also a good driver of gold. This is what has been driving gold, and it's a long-term drive, not short-term. Okay. So these people are on top of things, and now it's starting to overtake the treasuries, which is known to be one of the safest in the world. Maybe gold knows. Okay. At Neptune, we have been talking a lot about the private equity and private credit space. It has had a roller coaster of a year, last year and this year so far. Blue Owl, BlackRock, Ares, all these firms have been showing huge cracks, gating their clients. It's been a tough ride. This is not a good year for them. Um, this is private credit, private equity. This is just stuff made out of nothing when you're loaning or whatever it might be. Because I do mention this because it is the opposite of our world, which is a physical, real asset investment. So yes, you could have made good money in a lot of these, but these seem really risky in today's environment, and it's starting to show. Okay, it's not stopping. So private equity. So we've seen liquidity and exit risk, right? The Blue Owl permanently shut its redemption gates recently. So you can't get out of certain funds shut down. They have to return the capital. They will get it back, but you just can't request it, which is scary. Which is scary. I'm not trying to scare you, but I mean this is stuff that you got to look out for. This is not a liquid asset, not liquid at all. Okay, the interest rates and growth have just completely decimated some of this stuff. So private equity, that's the considerations happening right now. Then there's private credit, people who couldn't get the loans at the bank, right? The ones that are getting, taking a little bit more of an interest rate on from individuals in these companies. Apollo completely limited their withdrawals of their debt solutions fund. There was just too, I don't recall exactly what the issues were, but it just were issues of the underlying assets, right? So they have been structuring this, and this is, BlackRock and everybody else. So these people have been doing this, and it's not stopping, and it has been showing more headlines lately. I've seen it on the Bloomberg recently. They're talking about it, CNBC, Fox Business. It's pretty concerning. There will be a time to get back in, but now is a pretty risky time. So for metals, let's look at what happens in 2026 and what people were looking to where they were calling that. Okay, so central banks are still buying a lot of it. That's not stopping. Currencies are remaining under pressure with the wars in other items. The US dollar is getting, it's getting some pressure on that. Okay. Investors want assets with no counterparty risk. We're seeing a lot more of this. Go direct if you can. The counterparty risk, just like the credit funds and the equity funds, those are all people in between. Counterparties are people in between funds or businesses or others that are in between. You want to get as close as you can. And silver is the huge demand from defense, solar electronics, and data and energy we're going to talk about. There's 20 pounds of silver in each missile that's being sent right now. So
Wow.
that's a lot gone. Obviously, that's gone when it explodes. So that's
Wow.
just not coming back. Okay. Not short-term these multi-year forces. So let's look at what these big institutions were expecting. These are from late November, early December. I know it seems like eons ago, but I want to talk about it because every year the big institutions put out their price targets, right? And if I were doing this presentation a couple months ago, we'd be like, well, we're way past that. Yes, we have pulled back, which I think is a gift for anybody who wants to get into this market. But UBS and Goldman Sachs, they're all in that 4,900 to 4,500. Some of them are a little bit over 5,000, which we're kind of sitting around right now, right? So right now they're looking smart. Just a couple months ago, they were looking like they were way low, but now they're looking better. But I think they're going to be conservative. They are going to be conservative on their numbers. They don't want to shoot too high. So we're sitting around 44.50 gold right now. 68 to 72 silver. We're kind of bumping, hitting that level there, which I posted the other day that 70 is a key crucial level. But these people are at that. That's the big institutions. Then we're going to look at some silver, right? Silver's all over the map. 55, obviously, but that's on the low end right now. But even people like Keith Neumeyer at First Majestic were projecting over 100, which we were at for a slight bit. But we could see some of these people are in that 70s range. So we're kind of sitting there right now. We got a whole, 3/4 to go. So we'll see where it ends up. But I think we got some good floors and I think we're kind of sitting around a level where we might see some calmness come in. I know it's been a little choppy the past few weeks, but um, I'm feeling there's a lot of reasons that especially if the war or whatever you want to call it continues to truck on. Okay. Right, and also some of them started to update. Goldman updated gold to 5,400 since November, end of November, early December. Bank of America started to say, well, silver could hit 170. Deutsche Bank, huge. Gold could reach 6,000. Citi revised their silver target back to 150. Right? So they're always going to change their targets and say this is what we call, wouldn't you? But this is something that I would see. So we're well below all of these, right? We're well below all of them. I mean, some of them it's more of a double move, right? Especially on the silver side. So that this is something definitely to take a look at. I mean, these people know what they're talking about, but they are still, pushing for those higher numbers. We talked about prices, but I want especially targets. Let's talk about what supports it, right? Where is this? Not I wouldn't say a floor, but for lack of a better term, a floor. Like what's supporting these levels, right? We got to get these things out of the ground. It's not just what's trading above. It's new, right? So energy, oil, diesel takes a lot to get the metal out of the ground. Well, right now we got oil very high, right? Gas prices are high. They need to use this product to get it out of the ground. They need a lot of steel and equipment. Well, that's been the story of the past year with tariffs. Steel tariffs here, steel tariffs there, back and forth, tit for tat, whatever it might be. That's gone up. Everybody knows that's gone up. So and these companies, their operations are not, they're not away from this. They can't get away from it. They're going to have to keep using this product. This equipment breaks. They need to refill the tanks. This is just something that's going to support that level, so they will not take it out of the ground if it's not profitable. Labor and inflation. That's a lot has been happening. Costs have been going up. Labor issues in different countries where they're mining, right? Government spending and money printing. Well, the across overseas, the war that is costing a lot of money. Now they're asking for more, right? It's going to keep happening, and that spending puts more money out there, makes inflation happen, and traditionally and historically, gold and silver have benefited from that. So this spending is not stopping, regardless of what they say. They're still spending a lot of money. Every single missile, every single military action, asking for more. We just saw that. I don't recall. Was it 200 billion, Joe, or they asked Congress for? Or my number
I
off?
think that's it. Yeah.
Yeah, that's not a small amount of money,
No, no, it
right?
isn't.
So that's got to come from somewhere, and they don't want to raise taxes. So. It's got to come from somewhere. So this is what supports it, right? It's going to have there is an all-in sustaining cost that we call it. So traders are looking at this, investors are looking at this. So let's go into a little bit how the physical market works and how this floor is there. And I want to relate it to gas and oil. Ironically, it's a big topic right now. So I want to see how you guys. So I want to show you how this kind of works, so you guys get an understanding of where this, the cost to get out of the ground, but the cost to buy the metal, like it's a lot different, right? It is, and that's okay. That's normal. So you have the mining, you have the refining, right? You got to make it into a 99.95 plus purity or more, 24 karat to be investment grade. You got to mint it. You got to make it a bar. You got to make it a gold eagle. You got to make it a pan 1 ounce bar, a 100 ounce silver bar. Or you got to pour it, minting, pouring, whatever it might be, right? Big silver bars, 1,000 ounces. They're never 1,000 exactly because they pour it until it looks about right. Then they weigh it and then they stamp it. So, but the minting is the perfection, right? They get that. Then you got to go into the major trading hubs. There's companies out there that are trading the metal, they're buying it directly from the US Mint, directly from the Canadian Mint, from all these other mints. Some companies like us do buy directly from some mints, but mostly precious metals traders and for retail and will work directly with these major trader hubs, and they come to us, and then they end up at the end buyer. So that's essentially the process, and the reverse does happen. The buyer can sell it back to somebody like us, like the dealer. May turn it around, sell it back to a buyer again. Or quite often it does go back to refining or melting, right? It goes back to that stage of the melting and refining, and then it gets turned back into a product, right? So if you take your jewelry back to a local store, or even some old gold coins or gold bars, most of the time they're sending that just to a melter refiner. and that's going, and then somebody like the US Mint, or there's Sunshine Mint's a big popular mint in the United States, and Golden State Mint and all these places. They return it back into a new product, which goes back into the system. So that's how the process in trading works. And you may understand a little bit of this when we look at gas prices, because we see the spot price every day for gold trades every day, right? And that affects how much you're going to pay for a coin. Well, we hear about the oil price affecting the gas price, but you're not buying oil. You're not, you need the gas. So it's a similar aspect. You have to get the oil out of the ground. You have to refine it, make it in the fuel. It goes into distribution to the gas station to your tank. Now you can't resell it back, but when you see oil going up and you're like, okay, and then you see the gas price the next day, it's a little different there. The gold market is live. When you see that spot price and you see you starting with the mining, and then you see the spot price, the minting and major trading, like then the end buyer has to pay a little bit more than the spot price because there's a premium. And that's very live in that aspect. But it's similar to when you're not buying a gallon of oil to go in your tank. It's not going to be the same price, right? You got to have some processes, and then you're going to see that price that you finally pay. Um, that being said, in the gold market, it's much more thinner than turning oil into gas. So, I'm not sure about the math, but it's definitely a lot more. A gallon of gas is a lot more than a gallon of oil, right? So that's how the trading works. And a little bit more facts there. So yes, barrel of gas is not the same cost as a barrel of oil. Um, the 1 ounce, like a bar, always has a premium to the live spot that we quote. So you're going to see that. That's because we're refining and melting. Um, so one factor is like spot gold, right? So when you see the gold price going up, that's supply demand. Products do have their own supply demand. So sometimes in Gold Eagle, 1 ounce is a little bit more expensive than a 1 ounce gold bar. Both contain an ounce of gold, but they have a little bit different. Sometimes they will maneuver around each other because in the marketplace, um, there might be a little bit more Eagles, let's say, that are available. So the price comes down relative to the live spot price. That is just a natural market supply demand. It's pretty interesting that you have this little supply and demand around the supply and demand of the product around the supply and demand of the gold. So it's more like a type of a house on a street of similar houses, but there might be a lot more of that style that was built, because they're all boxes, right? People might want to get in, or the corner house, and that maybe corner houses are not in demand right now. There's too much problems in the corners. So now everybody wants a park house or something. It's all the houses, they're all about the same size, but they're going to have supply and demand within the marketplace. The houses are going to go up and down with the market, just like gold spot. So you have this inter product supply and demand, which is really neat. And one thing to make sure is, like somebody like us, you always want to purchase a London Bullion Market Association approved mint, the US Mint, Pamp Swiss Mint, Royal Canadian Mint, Perth Mint. These mints and refiners have gone through, and all of the accreditation and their processes are approved by London Bullion Market Association. There's a stamp of approval on there. Their products trade better in the marketplace. You would probably get a little bit more for it, or at least a better bid. We only work with those types of products that are, LBMA or futures market approved delivery. Yes, and the COMEX, when you're buying a future, we hear about that price. They utilize the LBMA standards. You can only provide a product on that. There's also another ISO 9000, but most of them are LBMA, which is something that you need to make sure you know. Now, I'm going to go over a little bit of the difference between direct and ETFs. Okay. There's both have value for certain investors. Okay. And ETFs, there's a lot of good and there's a lot of bad. Okay. So they are great for short term or day trading. you don't short-term trade physical metal. It's for long term. There is spreads there. You got to make sure that you're buying for a little bit longer than a day or a month. Now the ETFs track the price, right? Says right in their prospectus, it tracks. Yes, some of them have the bullion backing, or they say they do, and most of them do. Some of them are questionable. Some of them are much, have a better, um, what would they say? Have more of a, how would I say? Ah, they do have a reputation to have it, right? Somebody like the Sprott funds, Air Sprott and what he's done, they do have are more believed to definitely have every bullion backing as opposed to some of the others. You have to be willing to accept some counterparty risk if you're going to buy an ETF. You're far from between. You have your broker, your custodian, the custodian of the metal, the trustee, and the vault. You have like 7 people in between when you buy an ETF. You can get it, take delivery, but it's tough and you need a lot of money. Limited or no delivery options, right? So now, physical. If you want to actually own the real asset, you want to control it, you want to have it, you can have it in your hand, or you can have it in your IRA account at a vault that you have a separate name on your account, right? So you're named at the vault, right? You have a sub account direct name. The actual vault account itself is a custodial account, which is owned by you. It's not an asset on anybody's books where you're owed. This is a real vaulting or in your hands. Okay, you want this for medium to long-term holds. I do often advise clients, like if they're looking to go in and out within a week for some reason, it's just not the right word. Physical is not for you, and that's okay. But you want the longer term holds. That's what this market's for. You want to reduce your counterparty risk. I mean, you have it at home. The only counterparty risk, I guess, is the lock on your door. But when you have it in the vault, you still in your name, you're limiting it, right? They don't own it as their assets. So if they go out of business, no creditor can claim the bullion. It's your bullion. And of course, you want a strategic portfolio allocation. Global, and one important item is that for some of our clients, we have moved and repositioned them globally. We've taken their metal in one location, delivered it to them in another location. We've done this by trading with international trading companies, or just ship the metal. But you can just move the metal whenever you want. It's real metal. It's yours. You can do what you want with it. You can't move an ETF, right? You can't move the other stuff. And it can actually have a lower cost to carry. So let's take a look at that. So we're just going to take the big names, the gold, the GLD, the PHYS, the SLV, and the PSLV. These are the GLD. This is the funds of the 4 major funds. These companies are doing 41 basis points and 58 basis points, or the CEF, which is a mix of gold and silver. You can save money by going into the proper storage account, right? You don't have to pay some of these extraordinary fees. They are just arbitraging the storage fee, assuming they have the metal, right? They're just arbitrage storage fee. They're not doing anything for you. They're not trading it. They're not making you money, right? They're paying a very, 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 very little fee to store it, upcharging it, putting a ticker on the exchange, and then taking the spread. Yeah, it seems like a nice business, but if you're a long-term holder, that might not be your best bet. If you want to save some money, you can get cheaper rates, right? So you can talk to us about that. You can boost your costs. Your overall, you're gonna be in the black. So something definitely to consider on that. And final, I'm just going to talk about our company. Got to throw that in there and who we are, and then we can open it up and everybody can get on with their lunch. Okay. So Neptune, we've been around since 2002. So well over 23 years, continuous operations. Full service precious metal dealer market maker in the global bullion market. you acquire the metal, you can buy it from us. We can also buy it back from you. Okay, so we have our own proprietary investment products that offer key advantages. We have the vault accounts where you can actually take an allocation of metal directly in your name at the vault for a better price than some of the other buying a coin or a bar. Okay, so these are designed to reduce the counterparty risk. You still will have the um your name at the vault level. So other than that, we do bring institutional grade solutions to independent wealth advisors as well. We work with actual real wealth advisors. So if you're there may be some wealth advisors on this presentation, but those out there, and what I found is, you want to be able to work with somebody who works with professionals too, right? If you're an individual investor, you want to, okay, these guys also work with the professionals. So they have our trust, and we're hoping you have our trust as well. Joe?
Good stuff, Brandon. Good stuff. Hey, some of the questions revolve around the same idea. If for our audience, it's self-directed IRAs and 401ks, if they wanted to invest in metals, can you go through, I mean, what do they do first? They might be accustomed to finding real estate and putting that in their portfolio or investing in a fund. And but where do they go to find, the gold store or whatever? Where do they go
Yeah.
to find it and find the product that they would invest in? What are the steps like?
Yeah, so this is the way the relationships works with Camaplan and as the custodian and Neptune, right? So in an IRA, um, you need a custodian that is a financial institution that does the proper paperwork for the client, legal um, IRA paperwork. So Neptune is a private precious metals dealer and custodian privately, but not we don't custodian for the IRA. So we are the supplier of the metal. So as an independent investor, you would with your IRA account at Cama that's funded you would direct to want to purchase metals. So our team would talk to you about the metal itself. We would say, okay, what kind of metal you're looking for? This is what's best for an IRA? This is what we would suggest type of metal. Since we're not suggesting you invest in metals, we're not advisors, but with the type of metal that you would put in the IRA, and this is what the costs are right now, and find that mix. So Camaplan you would say, okay, I want to buy that. You direct Camaplan to send the funds and the metal that you want to buy. We buy the metal, we source it, we use our own inventory, we go to the trading hubs that I spoke about earlier. That metal gets delivered to your Camaplan IRA account at the vault. Your separate sub account at the vault. That metal's there, it's in your Camaplan IRA, and then you can watch that grow and we'll buy it from you sometime in the future, maybe when you need to take your required minimum distribution. But that's where the separation is. First is opening and funding the account, which if you may have already done since you found out about this through Camaplan. And second would be to work with us to talk about it. Now you can, if you don't have an account yet, you want to talk about the metal first, by all means, give us a call. But we'll be the ones supplying the metal in the end.
Got it. Got it. And then they don't take Camaplan doesn't take um, receive the metals in any way. This is you source it, it goes straight to the depository, and it's in the name of the investor, the
Exactly.
investor's IRA. All
Yeah.
right,
Yeah.
that's good. You mentioned earlier about, and this is another question here, Dean, the miners. You're buying the management team, you're buying the location that they're doing their mining in, you're buying all of the costs associated with that location, and you're buying the debt and everything else associated with a business operation.
Mhm.
So for those of you in the audience who are real estate investors, Brandon, is this similar to the preference for some of our investors who want to own direct real estate? They want to buy the real estate themselves, or they want to have a lien position that entitles them to that real estate, as opposed to maybe investing in a fund that might hold a portfolio of real estate, or investing in a syndication that involves a single property, say an apartment. community of some kind. Is
Mhm.
this argument the same? For those kind of investors the people who want to hold commodities, for example, they don't want to invest in Exxon or Chevron. They want to invest
Yeah.
in barrels of oil, or they want to hold seed corn or whatever the commodity happens to be. Are you making the same argument?
Yeah, it's exactly the same. I mean, it's the when I was talking about the miners, like those are that's just a obviously a fund of companies, right? Not investing directly in a company underneath, right? So
Mhm.
yes, you are, if you're the proof shown that it has been better to go directly into the metal as opposed and if you could buy a real estate directly or as close as you can
Mhm.
without, a management team in between and some other aspects, yeah, that's what you if that's what you want to do, yeah, that this is very similar, right? I
Gotcha.
mean, there's obviously if you want to just buy real estate, you want to just buy a house, that's direct. That's going to come with a cost of all the closing costs, and that's fine. You want to rent it out or hold it or whatever it might be, that's the best way, right? You have to pay the taxes on it and different things like that every year and the maintenance costs. So there's all those factors, and it's similar with buying gold directly. You do have a small maintenance cost. It's a storage fee, right? You don't have property tax, but you don't have to worry about that stuff. But there's pros and cons on both sides. If you're smart enough to get a couple of good real estates and you know what, and these people know what they're doing, and you can make good money, and that's possible. But there's just a lot of risk in it, right? Just a lot of risk in buying a miner. Like some people, I used to travel with Sprott Global Resources, Rick Rule a bit, and he was very good at buying juniors. And that's him, right? Right. And he's really good at that. And, but we're not him, right? And he finds these and he's the one who actually gets in early. Some of these people can find these things and they're really good at it. But if you want to just
Mhm.
make sure you're safe and you have considered minors because they're levered, um, it just hasn't proven to be that way. It has not proven to be that way. It's been better to go into the direct metal.
At the beginning of the presentation, you had a slide with trading volume of different types of investment vehicles, and the gold had a surprising trading volume compared to other asset classes. Is that a snapshot, or is that historically the case that gold has that much activity going on around it? This would be, I
No, it's
think, your first
historical.
slide, or
It's not just one that's been updated a few times.
okay, but
But
it's pretty much the way it is and has been for a while
I
as
mean,
far as
it's a
trading.
world, and if you think about it, where in the world, like, is gold not present?
Yeah.
Where in the world? Like, every single country, and I'm talking about even just jewelry, yes, but coins. Every country has a sovereign gold coin. Almost everyone. It's like everybody's gonna be getting on the bandwagon because it's been made easier by some mints lately. Um, but everywhere in the world that is everybody knows what gold is. They buy it in some sort of way, silver too. Um, it's a huge market and it's the demand is there I just don't think it's been around longer than the S&P. It's been around longer than any of the treasuries have ever existed, right? It's been an investment for a long time and I'm not saying that people are saying this, but to think that it's going away anytime soon or that trading volume is going to change is, I think you're missing the point.
Just one thing about that. I mean, I'm old enough to remember the gold run up. I think it was in the late 1970s, early 1980s, and it
Hmm.
went way up. Equivalent in inflationary, in present dollars to where it is today. And then it went to sleep. It climbed back down and it went to sleep for literally decades. So I want to see the 80s, the second half of the 80s and the 90s until it started to climb in the first decade of this century. That would be one of my fears. I bought during the first decade of this century, very early in it, and I'm loving it. I mean, it's great. But my fear is that at some point it's just going to deflate like it did before. And I know the market
Yeah.
conditions were different and go back to sleep and become an out of favor asset. What's
Well,
what's the argument against that?
I would be scared if I only bought gold, right?
Yeah, right.
You're
You
not
never buy
only
just one
buying
asset.
gold.
Yeah,
I'm not
exactly.
only buying gold.
Yeah.
No, nobody in my industry is all 100%. Actually, I wouldn't say that. I know some people that are 100% in gold, but that's going to be the case. At 100% is there's 100% crypto people now. Now look what's
Yep.
happening there, right? So, if it's going to sleep and it's only 10% of your portfolio, I mean, maybe you're sleeping better because you never know about the other 90%, right? So, I
That's
mean, think
good.
about your sleep, not the gold sleep, right? Sleep is
Yeah.
precious.
All right. Well, we've tried to play stump the guest enough right now, so I think we've run out of questions. And I want to thank you for your time. I want to thank everyone who tuned in to sit with us over their lunch break. We appreciate that. We hope that we've provided something of value and education. And Brandon, again, thank you for your time. This is of great value to us and to our audience. So you take care. Everyone listening, take care. And we'll be back here next week with another webinar. Please check our website, sign up for it so that you get alerts. And we'll see you next week this time. Take care. And thanks again, Brandon.
Thanks, Joe. Thanks all.